it's Keith Fitz-Gerald. Welcome to today's 5 with Fitz. I am back in the Pacific Northwest after a fabulous few days in Dallas, Texas, speaking with hundreds of like-minded, super smart, super savvy, and I might add, super calm investors. So anyway, I'm glad you're here today because this is a big day in our economic history, and I want to talk about that for a minute. Scores of people found out the hard way last week that they've been speculating, not investing. Now, thank goodness we don't have that problem. And I say that because we know that the cost of missing opportunity is always more expensive than trying to avoid risks we can't control. And because we talk about that stuff all the time. But even so, it begs the question, two actually. What do you do when buy the dip isn't working? And two, how do you rebalance your portfolio when the markets are under pressure? Now, the fabulous Stuart Varney asked me about both of those things ahead of today's opening bell. And you can watch that on my channel if you want. But the short answer is that you focus on the stuff you can control and you don't worry about the stuff you can't. That's the deal. And when you're going to rebalance your portfolio, you balance that with low beta, high dividend stocks that are nice and stable. That gives you the freedom to pursue those that are higher growth and more volatility. Now, most investors want to believe that what's happening now is new or unprecedented, but that is simply not true. The financial markets, in fact, have been a circus for hundreds of years. Decisions that you make now could define your wealth for a decade or more, and that's something I mentioned in last night's short. You can also watch that on the channel. So dang it, do your best to make good decisions. I mean, it's really not that hard. Now, I know that you may not believe me. Fear, uncertainty, and doubt are powerful anti-motivators, if that makes sense. But it is important that you try, critically important that you try, actually. Markets crash, but the world doesn't end. They recover, then they grow, and they do it over and over again. Now, I know that's hard to believe, and I know that you may not have the perspective on history that I do, so I took a quick spin through the books that may help you establish a perspective and hopefully some confidence too. So let's talk about 10 historic market crashes over the past 679 years that make what's happening now look like a cakewalk, along with what's happening afterwards. So, number one, the Florentine banking collapse of 1345. Now, medieval Europe's financial system collapsed when major banks like Bardi and Peruzzi failed. But trade, industry, and the Renaissance, the Renaissance itself followed. And in fact, Florence became one of the richest cities in Europe. Investment in art, architecture, and commerce exploded after the crisis. Number two, the Dutch tulip bubble of 1637. Now, this is a big one. It's in a lot of history books, but not for the right reasons. Tulip prices fell 99% in 2 days. They were a source of great speculation, just like many of the social media stocks have been recently. But the Dutch economy recovered quickly, and Amsterdam in particular became a global financial powerhouse, eventually creating the first stock exchange and modern banking practices. Then there was the South Sea bubble of 1720. Now, British investors were ruined when shares of the South Sea Company crashed 90%. But the British government stepped in, reformed financial laws, restored confidence, and by the late 1700s, Britain had entered the Industrial Revolution, unleashing centuries of growth and profits. Then, of course, there was the Panic of 1873. That's known as the Long Depression. Stock markets collapsed across Europe and America. 10-year global downturn followed. But it set the stage for the second industrial revolution, with railroad, steel, and electricity dominating the investment landscape. By 1900, the U.S. had overtaken Britain economically. Then there was the Great Depression itself, 1929 to 1932. The Dow fell 89%, and there was 25% unemployment. But those who bought in 1932, who bought into the markets in 1932, saw returns of over 1,000% by 1954. And America emerged as a global superpower and ushered in decades of innovation, growth, and middle-class expansion. There was, of course, World War II and the post-war boom from 1939 to 1945. The markets, of course, stumbled during the global war, rationing and fear, but the post-war recovery fueled the golden age of capitalism and GDP growth, home ownership. The S&P 500 rose 500-something% from 1942 to 1962. Black Monday, 1987, the Dow crashed 22.6% in a single day. I mean, that was the first big crash of my career that I lived through. But importantly, the markets recovered within 2 years, and in the 1990s became one of the strongest bull markets in U.S. market history, fueled by things we know today: tech, globalization, and the internet. There was, of course, the dot-com bust, or the dot-bomb bust, as the case may be, from 2000 to 2002. People forget, but the NASDAQ lost 78%, and tech stocks got carried out feet first. But the survivors, Amazon, Apple, Microsoft, many of which are household names today, became trillion-dollar juggernauts. Investors who bought back then are now sitting on 10,000+% returns today. Global financial crisis of 2008, 2009, Lehman Brothers collapsed. The S&P 500 lost 57%. But from March 2009 to 2020, the S&P 500 returned more than 400%. Investors who held or bought were richly rewarded. That's what you want to focus on. And finally, most recently, there was the COVID crash in March 2020. It was the fastest 30% drop in history. But the S&P 500 doubled within 17 months, making it the fastest double on record, if my memory is correct. Tech soared, remote work, digital payments, biotech, and AI all entered what I call a hypergrowth phase. Now, the point of all this is you focus as an investor on what you can control, like buying great companies that have been put on sale, rather than worrying about what you can't, tariffs and geopolitics. Always remember that history favors the bold, not the fearful. Investors who stay the course, even when they don't want to, and even if doing so seems to be a bad idea, tend to reap the rewards. And that's important. So today's bottom line is especially germane, especially important. Down markets, like the ones we're living through right now, are not something to fear if you've done your homework ahead of time, if you own strong companies. Why? Again, history shows very clearly that stocks getting hit the hardest often bounce back the fastest. Great companies making great products tend to produce great results over time. So those are the ones you want to focus on, especially at moments like the present. Now, wrapping up, as always, let's make it a great day and a great week. You got this, I promise, and I'll see you tomorrow.